What if the biggest transformation of your money, your savings, your purchasing power, and your financial future is already happening? And nobody ever asked you to vote on it. What if the rules of the monetary system are being rewritten, not in one dramatic announcement, not with tanks in the streets or headlines declaring a new currency regime, but quietly, gradually, through policy shifts, emergency programs, digital infrastructure, and crisis-driven decisions that most people interpret as temporary, when in reality they may be permanent. And tonight on Finance Lumina, we are pulling back the curtain on what many are calling the Great Monetary Reset Nobody Voted For. A shift not declared, but implemented, not debated publicly, but executed through central bank balance sheets, fiscal stimulus, debt expansion, and digital transformation. And the mystery we begin with is simple yet unsettling. If money is the foundation of modern society, who decides when it changes, and at what point does stabilization quietly become transformation? Because to understand whether a reset is truly happening, we must first understand how past resets occurred. And here's the twist. Monetary resets rarely begin as resets. They begin as solutions to crises. And those solutions accumulate until the system itself looks nothing like it did before. So let us rewind to the origins of the modern monetary order, because money was not always paper-backed by government decree. For centuries, it was tied to physical commodities like gold and silver, anchoring value to something scarce and tangible. And by the late 19th and early 20th centuries, much of the world operated under variations of the gold standard, which constrained governments from printing unlimited currency because notes were theoretically redeemable for metal. But constraints are uncomfortable in times of war and recession. And here begins the cause and effect chain that echoes through history. Because during World War I, governments suspended gold convertibility to finance military spending, printing more currency than gold reserves could justify. And after the war, attempts to restore the pre-war gold standard created deflationary pressures and economic strain, culminating in the Great Depression. And in 1933, President Franklin D. Roosevelt suspended domestic gold convertibility in the United States, effectively redefining the dollar without a public vote on abandoning gold ownership rights. And although framed as emergency stabilization, it marked a structural shift in the relationship between citizens and money. Then in 1944, the Bretton Woods Agreement established a new global system where the US dollar was pegged to gold and other currencies were pegged to the dollar, centralizing monetary power in the United States. And for decades, this system functioned as the backbone of global finance. But as US spending on social programs and the Vietnam War expanded in the 1960s, foreign governments began demanding gold in exchange for dollars, exposing the imbalance between paper claims and physical reserves. And in 1971, President Richard Nixon announced the suspension of gold convertibility for foreign governments, effectively ending Bretton Woods and ushering in the era of pure fiat currency, where money's value rests entirely on government decree and public trust. And once again, this was presented as a temporary measure to protect the dollar from speculators. Yet it became permanent, and this pattern is critical. Emergency action becomes structural change, temporary suspension becomes new normal, and each reset expands flexibility while reducing constraints. And with the gold anchor gone, central banks gained unprecedented power to manage economies through interest rates, open market operations, and later quantitative easing. And this flexibility fueled decades of credit expansion, financial innovation, and asset growth. But it also enabled rising public and private debt. Because when borrowing is easier and money is elastic, leverage becomes attractive, and by the early 2000s, global debt levels were climbing rapidly, asset prices were inflating, and financial engineering had reached dizzying complexity, culminating in the 2008 financial crisis, which became the next catalyst in our story because when the housing market collapsed and major financial institutions teetered on the brink, central banks responded with extraordinary measures, slashing interest rates to near zero and launching quantitative easing programs that created trillions of dollars electronically to purchase government bonds and mortgage-backed securities, expanding central bank balance sheets to levels previously unimaginable. And again, these measures were described as temporary, emergency interventions to stabilize markets, yet they persisted for years, fundamentally altering the scale of central bank involvement in asset pricing and liquidity provision. And here we see the rise phase of the modern reset, not through a single declaration, but through cumulative policy evolution, because low interest rates encourage governments to borrow more corporations to issue cheap debt for stock buybacks, and investors to chase yield in riskier assets, inflating equities, real estate, and bond markets simultaneously, creating what some analysts called the everything bubble. And then came 2020, a global pandemic that triggered synchronized economic shutdowns across continents, and governments responded with fiscal stimulus packages measured in trillions, direct payments to households, expanded unemployment benefits, small business loans, and central banks once again expanded balance sheets at record speed, purchasing not only government bonds, but in some cases, corporate debt and exchange-traded funds. blurring the line between monetary and fiscal policy. And here is where the term Great Monetary Reset begins to gain traction. Because within a span of months, money supply measures surged at rates not seen in modern history, deficits exploded, and the architecture of digital payments accelerated as physical commerce slowed. And while citizens debated health policies and lockdown measures, the monetary foundation was quietly expanding at historic pace, and the cause and effect sequence unfolded predictably. Massive liquidity injection combined with supply chain disruptions and pent-up demand eventually ignited inflation, and by 2022, many advanced economies were experiencing the highest inflation rates in decades, eroding purchasing power and forcing central banks to reverse course with aggressive interest rate hikes, marking the breaking point in this story because when rates rise after years of cheap money-hidden vulnerabilities surface, highly leveraged firms struggle. Housing affordability collapses, bond portfolios lose value, and governments face higher debt servicing costs, and the fallout spreads unevenly. Asset markets become volatile banks with mismatched duration, risk, and counter-stress. And households discover that stimulus-fueled savings are not enough to offset rising costs. And once again, policymakers are trapped between two risks: allow inflation to persist and erode currency credibility, or tighten conditions and risk recession and financial instability. And this dilemma exposes the deeper reset, because the monetary regime that dominated from 1980 to 2020, characterized by falling interest rates, globalization-driven disinflation, and expanding credit, may be transitioning into something fundamentally different, potentially a world of structurally higher debt, greater state intervention, digital currencies, and increased surveillance of financial flows. And while no ballot ever asked citizens whether they wanted negative real interest rates, trillion-dollar deficits, or central bank digital currencies, the architecture is evolving regardless, and here is the subtle but powerful shift. Money itself is becoming increasingly programmable and traceable as central banks explore or pilot digital currencies that could allow direct transfers to citizens, targeted stimulus, or even restrictions on how funds are used. And proponents argue this increases efficiency and financial inclusion, while critics warn about privacy, erosion, and expanded governmental control. And whether one views this as modernization or reset depends on perspective. The structural implications are undeniable because when the form of money changes, behavior changes, incentives change, and power structures adjust accordingly, and modern parallels reinforce this pattern. Just as the gold standard constrained governments until crises justified its suspension, today, a system of commercial bank intermediation and cash usage may be reshaped by digital infrastructure justified by efficiency and security. And shocking data underscores the scale of transformation. Global debt as a percentage of GDP has reached levels far exceeding those of the 1970s. Central bank balance sheets remain multiples of their pre-2008 size, even after attempts at quantitative tightening. And asset ownership has become increasingly concentrated as liquidity flows disproportionately into financial markets, widening wealth inequality. And this inequality feeds political polarization, which in turn pressures governments to spend more and intervene more aggressively, reinforcing the cycle of debt and monetary expansion. And so the repeating pattern becomes clear. Crisis triggers intervention. Intervention expands authority. Expanded authority alters the monetary structure. New structure creates new imbalances. And the cycle continues, and failed fixes punctuate the timeline from attempts at fiscal austerity that proved politically unpopular to brief efforts at balance sheet. Normalization reversed at the first sign of market stress to regulatory reforms that addressed specific vulnerabilities while leaving systemic leverage intact. And each failed fix nudges the system closer to implicit acknowledgement that the old equilibrium cannot be restored, that the era of low debt and strict monetary discipline is unlikely to return without severe disruption. And this is where the narrative becomes deeply personal, because while macroeconomic charts and central bank speeches may seem abstract, the consequences manifest in everyday life through housing, affordability, grocery prices, retirement security and job stability, and the question resurfaces with greater urgency. If money can be created at scale during crises and withdrawn selectively during tightening cycles, who ultimately bears the cost of adjustment, savers facing negative real returns, workers negotiating wages against inflation, taxpayers servicing growing public debt, and investors navigating volatile markets. And this brings us to the heart of the great monetary reset nobody voted for. It is not a single coordinated conspiracy, but a structural evolution driven by incentives, emergencies, and political constraints. Yet its cumulative effect may resemble a reset because the rules governing money's scarcity, neutrality, and anonymity are shifting. And as geopolitical tensions rise and nations explore alternatives to dollar dominance, including bilateral trade settlements in non-dollar currencies and increased gold accumulation by central banks, The global monetary order itself faces subtle recalibration, echoing the transitions from gold to Bretton Woods to fiat, and once again, such transitions rarely occur with explicit public referendums. They occur through policy decisions justified by immediate necessity. And so, what are the three clear takeaways from this investigation? First, monetary systems change incrementally until the cumulative shift becomes undeniable, and understanding history reveals that what is framed as temporary stabilization often becomes permanent architecture. Second, debt expansion and central bank intervention create both opportunity and fragility, inflating asset values while increasing systemic sensitivity to interest rate shifts. And third, technological innovation in money, from digital payments to potential central bank digital currencies, may redefine privacy, control, and access in ways that extend far beyond convenience. And here's the warning: complacency is dangerous in times of monetary transition, because ignoring structural shifts can leave households and investors unprepared for new regimes of inflation, taxation, regulation, or currency competition. And the open-ended thought I leave you with is this: if the value of money ultimately rests on trust, and trust rests on credibility and consent, how long can a system evolve without explicit public mandate before questions of legitimacy arise? And perhaps the deeper issue is not whether a reset is happening, but whether we are paying attention to the forces reshaping our financial reality. Because awareness is the first defense against being passively carried by structural change. And if this exploration challenged your assumptions, if it sparked new questions about debt, central banks, digital currency, and the future of money, subscribe to Finance Lumina. Share this video with those who believe the monetary system is static, and join us as we continue to illuminate the hidden mechanisms shaping the world's financial destiny.